Welcome to the Women in Wealth podcast, brought to you by Regina McCann-Hess, a certified financial planner with over 2 decades of experience. This show is for professional women who want guidance in working towards their retirement vision in learning, building, planning, striving for your dreams, and putting the work in now so that you can pursue your financial independence. Hello, I'm Regina McCann-Hess, president of Forge Wealth Management, and welcome to our Women in Wealth series. Today, we're going to talk about 529s. And when I started preparing for this podcast, I was really going to focus on how to use them to pay for college because I'm recording this late summer and I know tuition bills are coming up, and I know I have 2 college tuition bills coming up, and I know I have my clients have their tuition bills that I help them with. And every year I try to educate people on like, hey, here's how we should do it. And I'm always reminding people about, okay, send me the invoices so we can get them paid. And I thought, hey, why not do like a quick reminder for people how we use the 529s to pay for college? Because, we'll talk about saving for 529s or saving for college. We don't really talk about how to use them to pay for college. However, as I start to review all my information about 529s, I'm like, oh, I wonder if people know this and I wonder if people know that. So what I decided to do was do a 529 tips and using them to pay for college because there's a lot of good information there. And we also just had a new tax bill pass. So we'll probably have to redo another podcast on that once we get all those details. So for now, we're going to do some tips and tricks on 529 plans, just a variety of different information I thought would be helpful for you to know. And as I'm talking about taxes, I'm predominantly going to focus on the federal tax rules and tax issues that you could see with 529 plans because the state rules will vary. So, like some states will give you a contribution deduction, others won't. Some states will not give you certain availability with grade school, high school tuition deductions, taking money out for that. So I am really just staying at the federal level when I'm talking. So just as an FYI, just pay attention to that. Okay. So one of my first reminders are that when you have money in a 529 plan, the earnings or the growth are deferred. So it's similar to a 401k in that sense that, that money will grow tax deferred and, it protects it from having to pay a tax bill on it every year. Our next thing is also like a lot of people ask me, well, how are they invested? Usually inside a 529 plan, you have a menu or a list of funds that you can choose from, similar to what you would see in your 401k plan. So you're not going to have like 3,000, mutual funds or investments to choose from. You may have 10, you may have 15 or 20, but, it is usually very limited. Obviously, it can go from, bonds, which are less volatile, to all equity, which is more volatile, more risky. And then they also have age-based investing, which a lot of people do if they're not working with an investment advisor, because that's kind of like you're putting it on autopilot and it's easy because the younger the child is, the more equity and the more risk is in there. And as the child gets older and gets closer to college, then the fund itself starts decreasing the amount of equity and increasing the amount of bonds. So that can actually be good for people who like to set it and forget it, although there are people who like to have a little bit more hands-on and pick their funds. And the reminder there is that as your kids are in high school and getting closer and closer to college, that's when you may want to start, taking some of that equity and maybe moving it to fixed income. The other thing you can do as they're about to go into college, you can look at, what the balance of equities / fixed income is. And if you're still overweighted in equity, you bring it down a little bit, but then your next payment, like right now, if the market stays solid, what I usually do is, take the payments from equity. And I'm kind of like getting ahead of myself because I was going to talk about that at the end, but usually we take it from the equity if the markets are good. And if the markets are not so good, then we'll take it from fixed income. So to kind of balance it out. But as your kid is approaching college or entering college, you definitely want to pull back on some of that equity so that if and when we have market volatility and it's your time to, pull money out of that 529, to pay the tuition, you don't have to sell while the market's down out of your equity funds and maybe use, hopefully your fixed income at that time is not as volatile. So that's one of the things that, I want to kind of just cover. Now, again, just remember, there's all sorts of levels of risk inside these 529 plans because you are investing in the stock market. Whether or not it's bonds or stocks, there's still volatility because the bond market has volatility too. Okay, so one of the other things that I love about a 529, because, hey, I'm a control freak, not a surprise, right? But the owner, whoever opens the account, says they're the owner and contributes money to it, they are considered the owner and they have control of the assets. So they are the gatekeeper essentially. So the kid can't say, I want you to, send me a check for $5,000. No, I'm not doing that. I am in control of this money. I will send the money directly to the college or, whatever I decide to do or how I decide to pay for the college experience. That is something that I get to choose, not the beneficiary. The other thing that I can do as the owner and the controller is to change my beneficiary. So if I do have 3 kids and, say if I wanted to, my oldest is done college, I could take some of the leftover money out of his 529 and make one of the other kids a beneficiary if I wanted to. So I can do that at any time. The only thing I would have to be careful of there is if I made, let's just say, we have this 529 for another 10 years, we don't do anything with it, and then that oldest child has a baby himself, then the 529, I can change the beneficiary from my son to the grandson. However, that could have a gift tax implication because it's going down a generation. So those are things you do want to be careful of. So, and there are also plenty of other ways that you can deal with leftover money. You don't have to change the beneficiary. You could use some of that to pay their student loan, which I'll touch on. And you can also use some of that money for a Roth IRA. So those are great uses for the money as well. So just remember, if you go down a generation on changing beneficiary, you could pull a gift tax trigger there. So just be careful. The other thing, and this is, I think, very, very important for parents or grandparents, whoever's on that plan, you can name or assign a contingent owner. And what that would do, so I'm the owner of the plan, my husband's the contingent owner. If I go out and, get struck by a bus, he's there as a contingent owner, he becomes full owner. And that way there's continuity with taking care of that 529 plan. And the other thing is you want to, with the continuity of the 529 plan, then he could then assign somebody else as a contingent owner, maybe one of my brothers or his brother, so that the child doesn't have immediate access to that if they're too young. So you don't want a 10-year-old getting access. Well, they wouldn't really be allowed to have access to it at 10. There would be some kind of formation there, I would hope. However, you still don't want a young person getting access to 529. That's a lot of money. So you always want to have a contingent owner in there just in case something happens. So that's another thing. The ownership of the 529 plan matters, and not just for the control issues. I do like the control issue. However, changing beneficiaries, all that fun stuff. However, it's really important for financial planning as far as signing up for the FAFSA and doing all that paperwork. So if it's in the parent's name, it does get assigned in the FAFSA federal financial aid formula as the assets of the parent. So parent assets can reduce a student aid package up to 5.64%. So the 529s in my name, when I'm doing the FAFSA, get pulled in, but they're only about 5.64%, the assets determined for financial aid, essentially. Now, here's the thing. I wish I had known this. Well, this rule did just change a couple of years ago, but, would love to go into that little time machine and reset up my 529s from 20 years ago. The 529 plans owned by grandparents are not reported on the FAFSA. So that is money that when you're applying for financial aid, they don't see it on the spreadsheet. So that is a good reason to have grandparents owning the 529. Now, flip side to that is the CSS profile, which a lot of the private colleges have you fill out. It's just another financial aid form, essentially. A lot of them do require the assets, even if it's in the grandparent's name and the 529. They want to know about those 529 plans. So it could be pulled in if you're going to a private college. So that is something to be aware of. Now, the other thing that we want to talk about 529s is, again, grandparents, especially a grandparent with significant wealth, they may be able to use the 529 plan to reduce their estate plan exposure. Their annual contribution to the 529 is a completed gift, and it will reduce their estate tax exposure for that particular money. Now, a contribution amount in 2025, doesn't matter who, contributor is, you, the grandparent, whoever, is $19,000 per year. Now, if you're married, that's $38,000 per year. And if you were to do something called like a 5-year gifting rule, where the 529s allow you to put your 5 years worth of gifting into the plan all at once, then that would be $190,000 for the couple. The thing about that is you can't gift to the child at all in that 5-year time period. So you do have to be careful about that. And if you were to pass away before that time period ended, let's say if you died in year 3, your contributions for year 4 and 5 would be pulled back into your estate plan. So that's just one of those little things to keep in mind. However, if you are still here with us after that 5-year period, you just got a chunk of money out of your estate for the kids. And it's a great way to gift to the kids. Just a little FYIs. I told you it's full of like odd random little tips here because as I was thinking about this, it was like, oh, and this and that and the other thing. So bear with me. So the other thing to know is that withdrawals are free from federal taxes if used for qualified education expenses. Well, what is a qualified expense? At just about any accredited secondary American institution, including graduate schools, qualified education expenses from a 529 plan include the cost of tuition, fees, books, and supplies. Supplies would be like computer software, things like that. Also, room and board expenses can qualify. Now, there are limits to that. So usually what I tell people is, if your kid's in the dorm and they have the food package, that's usually covered. If the kid's living off campus in this nice little apartment, and the apartment is more, I was going to say double the cost of living in the dorm, but more than what it costs to live in the dorm, usually your 529 plans are limited to what the room and board, quote unquote, is for their particular college and their particular dorm situation and meal plan. So you do have to know about that. Most kids stay on campus at least for freshman year. Some schools, they stay on longer than that. But in a lot of situations, the apartments come in sooner rather than later. So that is something to know about for after the freshman year when they start living off campus. Now, the other thing that's the qualified expenses for students with special needs. So they may have extra expenses for going to college, and that obviously is something that would be covered. The other thing, just to remind you, is that 529 plans can be used up to $10,000 a year for elementary schools, high schools, apprenticeship programs, K through 12, essentially, for up to $10,000 per year. And then also, I had mentioned this a little bit earlier, you can use up to $10,000 for the lifetime of the child for a qualified loan repayment for the beneficiary. So I have done that with a few of my clients, so it was kind of cool. We utilized the 529 to take a little chunk of their student loan off, so it was kind of cool. Okay, what's a non-qualified withdrawal? Everything else. So here's an example. So you're living on campus. Obviously, the room and board is covered. You're ordering out the Domino's. No, that's not covered. Your transportation back and forth to school, your flights back and forth to school, you're going on spring break, all that fun stuff, not covered. Okay, so you don't want to pull the money out for that. If you do wind up taking withdrawals for things that are considered not qualified, you're going to have to pay tax on the earnings plus a 10% penalty. So, if you're in a 22% bracket, the earnings, are going to be taxed by 22% plus the extra 10. Now you're at 32% on that money. So you do want to try to avoid that. Thankfully, haven't had anybody come into that situation, but I can see how easily it could happen if you don't have somebody saying, hey, that's not really covered. And I have had people ask me, hey, is this particular thing covered? And I was just like, oh, probably not. And then other things were. So it's good to keep track of. So, the exceptions to that penalty are if the beneficiary dies, becomes disabled, or also receives a scholarship that could reduce his or her need for the college fund. So that's another thing to keep in mind. Also, just so you know, again, we're trying to stay federal, but I did want to note that some states do not recognize the elementary or high school private religious tuition withdrawals as qualified withdrawals. So they may recapture any any tax deductions that they gave you. So that's something that you definitely want to talk through with your accountant about as well. So now the nitty gritty is like, how are we paying for the college costs from the 529? So, I mean, there's not really a lot of options, right? But I just want to talk through it. So you can pay directly from the 529 to the college, and literally is, sadly for a lot of 529 plans, it's still an old-fashioned check that, goes in the mailbox and travels through the box and the train and the bus and the train again, and then arrives at the bursar's office, right? I have heard that there are some 529 plans that pay directly electronically. Whoa, 2025, what a concept. I don't know. Some of the 529s I've worked with aren't there yet. The other thing is you could also, instead of paying the check going directly to the college, you could pay the college directly and then get yourself reimbursed. So you either get your bank account directly linked and pay it out of your bank account, and then the 529 is linked to your bank account, and then we automatically refund you after, obviously you have to give us the invoice so that we can make sure we get the exact amount. And that's option two. So is one right or wrong? No, you can do either way. I prefer myself, I like paying the school directly because it keeps it a little bit cleaner. And I'm literally pulling the statement off the website and saying, okay, well, here's what I need from the 529 plan. And the 529 plan I already have the 529 plan with the school's address for the bursar's office and, all the contacts and the student ID number and everything like that. And we do it today. They mail a check in the next day or two. And then a couple days later, the school gets it in the mail. So I've been doing that for years with my clients and for myself, for my own now third child going into college. So, it's not like something new. However, sometimes you run into schools that are very laid back about the timing of this. And I've also ran into some schools that are really, really tight about it. So two of the schools that I'm thinking of right now, they were just like, look, we know 529 plans, they take a little bit longer. Here's a deadline, but if you're a couple days late, we're not going to be up in arms about it. Just, try to do the best you can. And then you have other schools that say, okay, well, we're sending the tuition notices or, the bills out, including room and board, July 14th. And if we do not have your check in hand by August 6th, we are dropping their classes. That was very offensive to me, I will have to tell you. I don't know why they do it that way, but there are some schools that are very, very hard-nosed about this. I'm guessing they've had problems with people saying the check's in the mail and it just never shows up. So you do have to know the rules of the school. Like I said, two of the schools that I've dealt directly with for my own kids have been very, very, very lax. And, granted, I'm getting the money there in time anyway, but, it gives me a little bit of like leeway. Whereas the third school is like, here's the window and it's like this wide and you better get it here by then, which is fine. I'm going to be on top of it. But I also sometimes have to call clients and remind them like, hey, I know Johnny is starting another semester and I haven't gotten a bill yet. Can you give me the bill? And then there's a scramble. And then they may miss a deadline too. So if I'm not on top of it because they're not, sending me the bill, that could be a problem. So just know how the school is to work with. And usually when you go to those college orientation sessions, that's where you find out how strict they're going to be or how, laid back they're going to be, and somewhere in between. So it's all good. It's just knowing it, you'd hate these kids fight to get these classes. It's like the Hunger Games sometimes for the classes, right? So you would hate for them to lose their class and have to re-register into a different class or a class time that doesn't work for them. You just want to avoid that situation. So that's why I am just spending some time to, let people know about that. And then also the other thing, so I'm talking about fall tuition bills, right? Then we also have what they call the spring semester bills when the school class starts like probably mid to late January. They're sending those tuition bills out in December, and sometimes they're due in December. Most times they're due in January. But I will say, though, if you pay the tuition bill in December, you take the distribution in December of this year, but it's really for tuition in the year 2026. Your tax forms are going to be a little wonky. They're not going to match up. Not that they really match up well anyway, but for me, it drives me crazy. So I like to have it like a little bit more clean, or as clean as I can possibly get it. So that's one of the things. So speaking of tax years and tax time, when you do take a distribution from from your 529 plan for the tuition and room and board and all the qualified expenses and stuff, you're going to get a 1099-Q. Okay, so that's basically just a form saying, hey, you took this much money out of the 529 plan. We've reported that to the IRS. You will also get a 1098-T from the school saying, hey, here was the amount of the tuition fees and all this other stuff. Big surprise. This was actually a very big surprise for me. And still, after however many years I'm doing it, the 1098-Ts and the 1099-Qs don't match up exactly. It drives me insane. But it's common for them not to. One of the reasons is the definition of a qualified expense for 529 is actually broader than what is reported on the 1098-T. Then you also have timing difference, like I talked about, where your tuition, your school starts in January and the bill comes out in December and you pay in December. So that's a real reason for the forms not to really match up, because they're going to say it, but next year you're going to be all wonky. So it can definitely be confusing, and that is very good reason to be able to, it's one of the times I'm happy to just say, hey, here, accountant, please take care of this. But it is confusing. Don't be surprised. Or if you're surprised at the time, say, oh, wait a minute, I think I remember her talking about this. So I don't want you getting it completely out of the blue. All right. So lots of 529 questions, lots of 529 information. I could probably do a lot more here, but I was trying to do like just a quick, hey, tuition paying time is coming and can I get down and dirty and how to pay. But one of the things you can do, even if you don't have your tuition bill yet, you can set up the information within their system on their portals. Now, obviously, because we're parents paying for all this, we don't have a right to see all that information. I know, it's crazy, some stupid federal rule. Anyway, you can have your child that's going to college make you an authorized user. And my feeling is, if you want me to handle the financial part of you going to college, you need to make me an authorized user, right? There's just no way around it. So you go into the portal, you can set all this stuff up ahead of time before you have to actually pay the bill or while you're getting the bill paid. And, even if you're not going to pay the bill from your checking account, you're going to have it come from the 529. I still tend to link my bank account to that portal just in case there's like, I don't know, $150 charge for, being on campus, something silly that they always add in. And then I'm like, I'll just pay that out of pocket. That's fine. I'll leave the money in the 529 for like the bigger tuition bills and stuff like that. So that's something that you can do ahead of time. I do know that sometimes the housing bills are there early. I know I looked on my portal the other day and my daughter's housing fees are on there already. So technically I could pay them, but I'm more like, oh, I'm going to wait for the tuition bill too and just pay it all at once. And like I said, when the markets are up, that's when you want to take it from equity. You want to pay the bill from the equity in the portfolio. And when the markets are down, then we use the fixed income in the portfolio. So that kind of helps us, let the markets keep going up, but taking some of our gains off the top at the same time and hopefully avoiding having to sell into a down market. I've been through many, many down markets while paying tuition for myself or my clients, and this has worked pretty well. There have been times like 2008 when the markets were really, really bad. Sometimes we paid tuition out of cash and just let the 529 sit there for the recovery because, the markets were really beaten up. So, sometimes if you're in a fortunate situation where you can do that, then sometimes that is an option. But in addition to that, you can also just, when the markets are down, sell the fixed income to pay the tuition and qualified expenses, and you save the equity for when the markets recover. So thank you so much for bearing with me through my rambling diatribe about 529 plans. I think the call to action today is minimally get on the portal for your kids' tuition information. Get on the portal, be an authorized user, and take a look at what is expected. And definitely look at the deadlines. I think that is the most important thing. Look at the deadlines as far as the payment plans or when the tuition is due to avoid the kids getting their classes canceled as a result of not paying the tuition on time. That would just not be a fun conversation to have. Oh my goodness, we do so much for these kids, and hopefully one day we'll see them shine as a result of it. So thank you so much for your patience. I appreciate you hanging out with me today. Again, I'm Regina McCann-Hess, president of Forge Wealth Management. My website is forgewealth.com. You can follow me at Facebook, Instagram, and YouTube at Forge Wealth. And then LinkedIn, it's Regina McCann-Hess. Great day. Thank you for joining me for this episode of the Women in Wealth podcast. You can watch the Founders video I created for you to learn more about me and how I can guide you towards your financial independence at www.forgewealth.com. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision. Securities are offered through LPL Financial, member FINRA, and SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Forge Wealth Management are separate entities from the LPL Financial. Our show guests and their companies are not affiliated with nor endorsed by LPL Financial, Private Advisor Group, or Forge Wealth Management.